So we have Abhirup. Abhirup, he is the Chief Sustainability Officer at Oren. He's also a chief operating officer. There are multiple hats he wears at the company. And he actually has a very, very unique background. He's a petroleum engineer by background who went on to start his own company, which they started his own sustainability company actually, went on to become one of Asia's leading sustainability technology and solutions company. And in terms of the work that he's done extensive work advising companies across oil and gas, manufacturing, cement, industrial, and many, many more. Right. So welcome to this webinar, Abhiru.
Thank you, Arushi.
And along with Abhirup, we also have Kushagra. Kushagra is slightly under the weather today, but he was kind enough to still join us, right? So if you see him going off video, coughing a little bit, I think we can cut him a little slack there. So Kushagra is a seasoned sustainability consultant with over 8 years of experience servicing clients across financial services, manufacturing, engineering, design, and retail. As a subject matter expert, he has guided organizations in their sustainability journey, starting with developing their GHG inventories, crafting ESG strategies and roadmaps, leading reporting in alignment with global frameworks such as CDP, EcoVadis, GRI, TCFD, CSRD. He's done it all, right? And from an education perspective, he holds an MBA in sustainability from Terry University and an MS in sustainability management from Columbia University, New York. Welcome to the webinar, Kushagra.
Yep, thank you, Arushi.
And I'll quickly set some context on what we have planned for all of you today. Right. I think before I get into that, folks, if you have any questions, you will see a questions tab. Feel free to drop in your questions, right? And Rasadul and I are kind of sitting there in the background, watching your questions quite quite excitedly, right? If there's something that we can handle, we'll respond to you. We'll send across your links, send across those links to you. But towards the end of the entire conversation, we have 15 minutes dedicated, wherein we'll pass on these questions to our experts today, Abhirup and Kushagra, to take them on. Also, as they are going through the presentation, they have a very exhaustive presentation prepared for you. In case we think that something could add value during that slide, we're happy to kind of open it up to them at that point, right? I really request you to be on mute, right? It does kind of mess up with the flow of the speaker, right? Beyond that, talking about what we have in place for you today, we're here to cover a very, very important topic of IFRS S1 and S2, right? Today, there are very few companies out there globally who have actually published their IFRS S1, S2 reports. The Middle East actually has a few of those companies, right? I think just from a maturity perspective, when it comes to sustainability reporting or sustainability integration, my opinion is that the Middle East, the MENA region, is still at an early stage compared to certain other regions like Europe, UK, India, Singapore, etc. Right? But nevertheless, it's moving at a very, very, very fast speed. Right. In the 2024, in financial year 2024, Emirates NBD released their first, was one of the first banks in the region to publish the S1 as well as S2, right? Today, the team has been kind enough to kind of extract some information from that report that they think will be relevant to you. And beyond that, we have a lot of theory that we've captured, and also some practical implications and implementation strategies put in place for you. Right, so I'll kind of stop talking now. Over to you, Abhirup and Kushagra.
Thank you, Arushi, for the lovely introduction. Hello, everyone. Good afternoon, good evening, wherever you are joining from. So, as Arushi mentioned, today's topic is mainly around IFRS and the standards which are S1 and S2, right? So, we'll definitely get into the depth of exactly what is required in S1 and S2, what kind of data points are required, how to approach that, and what will be the strategy that you should follow, and all of these things that we have already covered. But I'll just try to start with why IFRS came into picture. And again, like as all of you joining us would be anyway aware of multiple reporting frameworks, multiple standards, which are anyway there globally, right? What has been the main idea behind IFRS sustainability standards, and what are they trying to achieve, right? So that is what is the main objective that we should start with, right? What is the intention around it? So if you go back in time, right, when there are multiple reporting standards for financial accounting, right? So like what was happening in terms of globalization, when let's say an investor wants to analyze that what is the company's performance in any financial metric for, let's say, any company which is based out of Germany versus, let's say, one is based out of let's say Japan, or maybe like someone is based out of UAE, right? So in that case, comparing any company's financial performance also was difficult, because every company in that particular geography would be following some or the other accounting standards which were very much particular to their geography, and at the same time they will be following some methodologies which are prevalent in that region or that country, right? So that was the primary norm. And for any financial analyst at that time, their task was, like, I would say 10x more difficult, because they would not only be analyzing one particular company's performance for that particular geography, but they do need to also know what is the method, what are the like terminologies that the other companies are using in the global world, right? So that's where in 1973, actually, IFRS, or maybe earlier, International Accounting Standards Board, they came up with something called as an unified reporting standard, which is being adopted globally as of today. And like, I'm just giving you a comparison that earlier the most prevalent standard that was being used was US's GRP, right? So US GAAP standards were nothing but basically a, like, you can think of it as a 1,000-page rule book, right? Which was mainly mandating that for this particular scenario, you have to report it this like this, right? So it is nothing but a guidebook on what to do in a particular scenario, and this is what they, like, any company was following. But then what made IFRS, or why IFRS standards basically came into mainstream, because they moved away from a guidebook or a rule book based approach to a principle based approach, where they made it much more broader for the understanding for any analyst, any reporting company. And at the same time, they come up with principles where they like handed over the ownership of their reporting to the particular company, that based on their best of the knowledge and the judgment, they can then make sure that what to be reported, what not to be reported in their financial reporting metrics, right? So, like, this has been the main background of how IFRS revolutionized the financial reporting aspect. Now, if you compare the same scenario, maybe pre-COVID, like before 2020, all around the world, ESG or sustainability has been a common term, and investors, regulators, everyone is coming up with multiple reporting framework standards. And that is, again, like, I would not say it's completely zero or narrowed down to a handful of them today. But then before 2020, there has been multiple such frameworks aligned to a particular type of reporting, or particular geography, or particular regulatory standards and all, right? Now, the IFRS, the main intention behind IFRS was to have a single framework which can help any company disclose their sustainability related data or matrices, as well as any kind of non-financial reporting, into a single structure. And then again, like, this IFRS standards also follow the same ideology or methodology that they are using for financial metrics, which is principle based approach. So rather than creating a rule book, IFRS, or under IFRS, there is International Sustainability Standards Board, right? So ISSB essentially regulates the entire, not regulates, it essentially overlooks the entire frameworks, the IFRS S1 and S2. And the methodology behind that has been the same like methodology that they are using earlier, which is a principle-based approach, right? So the major principles or fundamental principles that ISSB or the IFRS S1 S2 looks after is that to develop a standard which can be adopted globally, which provides information needed for any investors to look at, and also at the same time give that flexibility to the companies that they can disclose their sustainability information or sustainability prime KPIs in the format that they want to look at, so that they are capable and they are disclosing everything on a global market or global capital markets. And the outcome or the result of it should be that there should be an interoperability of all the reporting data from any company, from any geography, which can be used across jurisdiction, across boundaries, and across multiple stakeholders. Right. So that was the main principle behind IFRS coming up with this S1 and S2 standards. Now, if you look at it, today's scenario, integrated reporting, SASB standards, CDSB, TCFD, all of them are in a way or fully aligned to IFRS. In a way, we can see that the consolidation is already in effect and already happening in place. So that is what is the right way, or maybe like the intended way of having IFRS as a standard available in the global market, right? So that is what we have seen happening, and that over the years, anyway, it is going to be evolving and developing into a single standard which is applicable and palatable to every company and every geography, right? Now, in IFRS, um, IFRS has two standards, which are S1 and S2, right? So, what is the basic difference behind that? In IFRS S1, the primary purpose of this reporting standard is to disclose any material topic, any topic which is a risk or a financial risk for any company, or maybe a financial opportunity for the company. Anything other than climate has to be included into S1. So if it may be, let's say, your human rights, or it can be about, let's say, information security related issues, or maybe like digital adoption, or maybe today's days AI adoption, right? So it can be anything and everything which is related to sustainability, but at the same time also have some financial impact on your company. Those materials have to be reported in S1, and S2 is purely dedicated towards climate related risks and opportunity disclosures. So S2 is a standalone report, which is nothing but have the similar structure of S1, but then this is particularly focusing on climate related disclosure, which has to be disclosed in a particular format that IFRS prescribes. And again, like I mentioned, formats are not binding. It is more of a broader definitions of it. So that is what we have to follow and to be aligned with the IFRS standards. But then the basic difference between S1 and S2 is that one is very much focused towards climate. Everything else has to be reported in S1, right? Now, we have also seen multiple questions or multiple people asking that, can we go for an IFRS reporting only with climate if we don't want to do an S1? So to answer that, it is not two different standards which can be used on anyone's will. It is in a way an extension of S1. So for any company to report on S2, they have to have an S1 report. Along with that, they can report an S2, right? So it has to be looked at it as a single unit. It is not a two different standards talking two different languages. It is a single framework which is divided into two parts, S1 and S2, and a company has to report both S1 and S2 in their reporting requirements and reporting guidelines, right? So that is what I would say is the practical approach of S1 and S2. Now, I would also talk about how these two standards are different and how they are also almost similar, right? So if you look at the four pillars of the S1 and S2 standard, the four pillars are governance, strategy, risk management, and matrices and targets, right? So in governance, what exactly is being asked is that how any organization oversees or maybe creates a process around like all of these material topics for any company. Similarly, strategy is nothing but how a company aligns their entire resources that are available at disposal today to make it a win-win situation for them, and at the same time, how they are also looking after a long-term vision, that how they can convert any opportunity that they have in these parameters into a financial metric or into a business case there, right? Now, third thing is risk management. Like In IFRS, the main intention is to kind of link every material topic to the financial metric. That's where you can analyze it as per, let's say, if there are any risk, what will be the financial risk for that topic to the company? And on that, if it is a risk, how are we going to mitigate that? What are the process in place? What are the risk control mechanisms in the place? How are we mitigating it? What are the KPIs that we are tracking? So then, like the moment we have KPIs that are being tracked for each and every risk and opportunity, those comes under the fourth pillar, which is the matrices and targets. So there can be multiple KPIs that a company can like disclose and report as per IFRS. Again, like there is a flexibility that a company can take up. Obviously, there are some matrices which are going to be anyway applicable for all the companies, but then there are also flexibilities that you can report as per your like own goals, own material topics, and risk management framework. Right now, I'll dwell deeper into each and every pillar that we have discussed right now. So, first talking about governance, right? On governance, what exactly is the intent, or what exactly is the principle-based approach that IFRS is talking about? So, in governance, if I have to explain what is governance, I'm sure like you'll have heard about these terms multiple times, and there is no absolute right or wrong answer about it. But then, what I define or what we define as governance is that how an organization is defining their objective, who is going to lead or who is going to oversee that objective, and at the same time, who is going to be taking the accountability of everything which is going to be revolving around that particular process or that particular objective. So, governance, you can think of it that if, let's say, I am like, I'm just taking an anecdotal example here. That is, if I can think of it as a single project that we are going to do, or maybe like a group project that we are going to do. In a group, what we are trying to define is that out of, let's say, 4 people or 5 people in the group, who is going to lead the entire conversation, who will take the final edits and final calls on this. That person is going to be mainly the chairman or maybe like the head of that group of people, right? Similarly, what are we going to achieve and how are we going to achieve? That is going to be the part of the process. So, like, it is not about the steps or the tasks. It is all about how we are going to do this task and what is going to be the model around it. So, let's say example would be that in this group, if let's say we have to have this project completed in 1 month's window. In that case, the group is going to meet on every Friday, every week, and every person has to deliver their task by, let's say, Thursday, so that everyone gets 24 hours to read through those documentation. And on the Friday, when the people meet, they would have their own comments and suggestions around that, and then kind of collectively take the decision what is going to be the final outcome that they want to achieve, right? So this is basically a structure or a governance structure that the group is creating so that they can achieve the objective that they are trying to do. So that is the exact same thing that is being asked in the governance pillar. Now, in governance, you can have a single approach for both S1 and S2 because, as I mentioned, S2 is nothing but an extension of S1, right? So in that case, for any organization, the governance structure can be same for climate related risks and any other sustainability related risks, right? So like we have seen very few examples where the companies have different kind of structures for both the topics, but then more or less companies would have the same structure. Now here, when we like copy paste the structure of, let's say, the group project that I discussed about into an organization structure or maybe like a company structure, ideally the process would be someone at the board level who is looking after it, or maybe is it the chairman who will look after all the sustainability related risk and opportunities, climate related risk and opportunities? Is there any other committee in the board who is going to be looking after all of these things? Or maybe is there any kind of a external body along with internal teams who are going to be the governance team members as well as the leader in that committee? So that is one layer that we have to set up. Now, over and above that, right, as we have set up the topmost layer is going to be the final decision maker and maybe like who will take the final calls or chair the committee. Next thing is that how are we going to create a structure which is accountable to the organization and at the same time who are going to take that ownership? And that's where the like mid management and top management comes into picture. They are going to be part of this ESG or sustainability working groups or maybe steering committees, whatever you may call it. So there, these people from individual departments, functions, or maybe geographies would be looking after multiple such KPIs, multiple such risks, multiple such areas, which are going to be like clubbed together to us to give you a holistic view of a company, right? So that's where this steering committee or a middle layer comes into picture, and then there can be again a third layer, which will be mainly the working groups for any company, which will be very much focused towards one objective, one initiative, or maybe one risk that a company wants to tackle in particular geography or particular division or particular function, right? Now here the main key or the crux is that, like I mentioned, in IFRS everything stems from how a company approaches this risk. There has to be some kind of a financial accountability around that, right? So in that case, what it is also recommended is that when you kind of create your governance structure, there should be some KPIs, there should be some goals which is linked to their performance also, and they should be also incentivized for achieving those targets and goals, or maybe something or the other. So there has to be linkage between even individual performance, their incentives, as well as your sustainability and climate related risks and opportunities for the company. So this is mainly the intention behind governance. And again, like companies are free to choose the structure that they want to follow. But what we have recommended is mainly a structure that we have seen commonly like being followed by multiple organizations globally, right? So that is what is the overall perspective of governance. Now I would come to the management roles on system related processes, like I've mentioned about the working groups, right? So working groups can be helping or augmenting the work of maybe like the steering committee, where if let's say individual working groups are working on particular areas, like let's say I'm taking an example, if a company has an objective to improve their diversity on the workforce, right? So there can be a particular working group who is working on this. They might take into effect that, yeah, like for these functions we might be able to increase gender diversity, but for these roles or these functions, there it will be difficult for doing this. Or maybe for particular geography, it will be very much difficult. So the working group will be working on a particular objective or a use case or a risk, but at the same time, the overall management committees or steering committees would be looking after this more from a holistic viewpoint. So that is what is the governance model here. Now I would invite my colleague Shagra to just explain the example of one of the companies here.
Yeah, thanks, Tabiru. Yeah, so like Arushi mentioned about Emirates NBD, right? So we've looked at Emirates NBD at the group level. They published an IFRS S1 and S2 report. It's a pretty exhaustive, pretty lengthy document, and it's publicly available as well, right? So we've just taken certain snapshots or snippets, which could be most relevant to for you to understand, to just get a quick understanding of how companies are usually structuring it. And Emirates NBT is obviously one of the very large banks, leading banks within the UAE sector as well, right? Obviously, they are in the financial services, and if you are in a different industry, manufacturing industry or whatever, it could be slightly different. But then, just as an example, so what you can see here, they have given this entire board organization chart, right, from the board to the group heads to individual committees down to the most level, individual team level, investment banking level, capital teams, right? So their entire governance structure is what they have given as part of their governance reporting. On the right side as well, do you see in the asset management governance? So because this is the group level report, and within the group level, the Emirates asset management is treated separately. The asset management's governance is completely separate from the rest of the companies. So that's why they've actually broken their governance into two sections. When you see the overall group on the left, and specifically for asset management, they report separately. So that's the kind of detailing that they've actually, the kind of thought that they have given into reporting as well. Most companies, may not report in this level of detail. Most companies will just say we have just one level of committee. Even in the board, if you see, there's two major committees. There's the nomination, remuneration, ESG committee, and then there's a risk committee as well. So governance is may not be limited to just one company. You could have multiple companies or multiple individuals responsible even at the topmost level. So that is also something that you need to definitely report on when you are reporting at your governance about your governance structure. Then coming on to the role of the board. So like Abhirav was saying that how is the board looking at ESG? How is the oversight integrated, right? So like I mentioned, they have two different committees that look at their ESG and their sustainability metrics. Then competency and training of the board. So you can see they have the annually review is done. The remuneration and ESG committee recommends different programs, what kind of training should be done, what kind of programs can be taken up. There's on the right most, if you see, there's an annual review as well. They have where KPIs. So if you see the last highlight says a 5% reduction target is inbuilt into the KPIs of the board level committee as well. So it's something that ESG is taken at the topmost level. Priority is given by including these KPIs as a part of the variable remuneration of the board level as well. So right, you can imagine that how much of an impact that's going to cause, right? Because that will then drill down into the individual KPIs of each and everyone who is below the board, right? So that's the kind of importance that they're given. That's the kind of reporting as well that they're putting out in the public domain. Yeah, Abhinav.
Okay, so yeah, now moving towards the second pillar, which is the strategy, right? So now, on the strategy part, exactly like we discussed about governance, how is it different from governance, right? So in strategy, what we are trying to achieve or what we are trying to disclose is that, let's say we have a situation and the objective is to kind of mitigate this risk or maybe harp on those opportunities that we have. Maybe it can be like realized today or it can be in future. So what we are trying to do in our strategy is that what is our objective, what are our goals. So if our goal is to be, let's say, the leader in this particular area even after mitigating those risks, that is the objective. And now, like in the strategy, what we are trying to portray is that with the situation that we have today, it might be that we are already in a better stage, that we don't have such risks in our region or our geography, or it might be a situation where we have a maximum impact, right? Like climate can have different impacts in different geography. Like if you are, let's say, in the northern hemisphere or southern hemisphere, in the polar region, there the impact will be very different versus, let's say, an equatorial region, right? So that is based on the geographical presence that you have. So that's where, like, wherever you are right now, irrespective of the like physical location or maybe in terms of like the theoretical situation that you are or your organization is in the sustainability related risks or climate related risks, what is your strategy to kind of overcome those risks and to be achieving whatever you want to achieve in terms of your goals and targets. So that is what is the strategy that we have to disclose or report in IFRS S1 and S2, right? So when you talk about IFRS S1 and S2, the uh, things that we should be keeping in mind is that risk and opportunities that we need to identify is not only limited to what is there today or currently there in the company. It has to be also anticipated effects in the next 10 years, 20 years, 30 years, or maybe 50 years as well, which has to be aligned with your company's business model, which should also include your value chain partners into the ecosystem. It should not be siloed to only your organization and only your organization operating locations or operating boundary. It has to be going beyond that because any organization today working on a global scale, they do depend on multiple value chain partners, and that's where we have to account for everything into the ecosystem, right? Similarly, the effect of those sustainability related risks and opportunities in the financial position, how these risks are going to play today, tomorrow, in the next 10 years, 15 years, how companies who are our competitors, who are our peers, are going to look into it, what are their strategies around that, what will be the impact in our cash flow, how is it going to impact in our revenues, how is it going to impact our margins, what kind of investment strategies that we can implement today, what kind of risk mitigation steps that has to be taken internally by the organization, maybe like upskilling the entire workforce or maybe adopting new policies, tying up with industries bodies to kind of overcome some certain challenges which are going to be common across all the companies and all the peers there. So these are different strategies that we have to kind of identify and disclose in the S1 and S2 standards, right? Now again, Kushagra, for you.
Yep. So as you can imagine, like Abhirup mentioned, right, strategy is definitely something that's quite extensive, right? So even for Emirates NBD, the strategy section of the report is the longest section, right? It's because they detail extensive detail about all their entire strategy, right from the financial strategy, risk modeling, analysis, impacts of various scenarios, various risk right, opportunities. They have extensive detail of the entire strategy, right? We have just tried to bring out some very brief snapshot. So you can see their overall strategy is centered on five major themes, right? Financing the transition, because they're a bank, they do a lot of investments, right? So financing the green economy, financing the energy transition is something that they definitely have a lot of focus on. Their own achievement of their own net zero targets, disclosure, their enhancing of their disclosures, the digital transformation, obviously with AI and digitalization, the industry 4.0, right? So transformation is something that's another one of the themes, and then positive social impact. So it's not just environment, but even gender diversity within the leadership, right? They have a target of 25% leadership women in the leadership roles, right? And they are differently most likely on track to be able to achieve that. Right? I mean, that's not a comment; it's most likely possible. But that's the kind of disclosure that they're trying to do. And then specifically when you look into, let's just say climate related risk. So you can see what they've done is a double materiality. If you're familiar of the concept of double materiality, you have an impact materiality and then you have a financial materiality as well. Sorry. So you can see within financial impact materiality, they have taken the positive impacts as well as the negative impacts. Whether those are actual impacts or those are potential impacts, like Abhirup mentioned, right? They could happen 10 years down the line, they could happen 50 years down the line, right? So they have looked at what are the actual impacts as well as the potential impacts. Then from the financial perspective as well, they have looked at, what are the risks to us within the short term, medium term, long term, what are opportunities for us within the short term, medium term, long term. you know so for a financial industry, financial services bank, uh, setting up renewable energy projects, setting up solar projects, hydro energy projects, those are opportunities that they can definitely invest in. Those are new business lines for a manufacturing company as well, with the climate change, setting up of the entire EV industry. That was a opportunity for like Hondas and Tatas and all the other global Teslas. They're all getting into EV manufacturing. That's an opportunity due to climate change, right? So that's how they've looked at their entire risk management. The entire, I would recommend all of you to go and read this report. It's a pretty huge report, pretty extensive strategy section as well. So I hope this just tries to, tell you on what kind of approach that these companies are taking, these very large companies are taking towards IFRS reporting as well.
So moving on to the third pillar, which is nothing but risk management. So like Kushagra already showed you the materiality assessment, right? So as all of you are from, let's say, systematic and ESG background, you will be familiar with that. That's why I'm not covering materiality assessment process. But then in the risk management disclosure, right, or maybe like the third pillar of S1 and S2, what we are essentially trying to do based on the materiality assessment that you have already performed for your organization and the inputs that you have got from all your stakeholders, right? We definitely do a prioritization of the topics or prioritization of the areas based on the stakeholder identification and maybe like the response that you have got from them. But then here on the S1 and S2 perspective, as we know that S1 and S2 definitely asks you to kind of link all of these risks and opportunities with the company's financials. That is where it is very much important to understand that for each and every sustainability related risk or climate related risk that you identify, you have to assess that what is the nature of this risk, what are the likelihoods of this risk, what would be the magnitude of that risk, and what are the effects of this risk on your company in terms of your, let's say, financial impact. It can be a quantitative approach, it can be a qualitative approach where you can just like identify it is high, low, and medium, or else it can be just a number that you quantify based on every aspect or every kind of like risk management that you want to do around a particular topic, right? So risk management will essentially need you to link all of these material topics for an organization with a certain risk. It will be really great for any company to identify what will be a revenue at risk, maybe today in 5 years down the line, by 2030, like by 2040, 2050, so that you can also evaluate that how these risks are going to be impacting. Is it going to be an upward trend or a downward trend in terms of our revenue at risk or maybe margin at risk? Is it going to like decrease my like being relevant to the industry or being relevant to the right set of customers that we have today, right? So there are multiple ways to analyze that. If you are able to come up with a quantified number, or let's say a particular number to quantify this risk, then the mitigation strategies and everything around that would become very much like visible to you, and it will be very easy for any organization to kind of analyze and like also disclose things in a clear black and white manner, because you do know that what is going to be the impact in the next 10, 20, 30 years for the company. And that's why we are trying to take these mitigation steps, which are going to be, first of all, these checks and balances that are there in the entire organizations. And then moving forwards, if these risks are beyond our mitigation, beyond our controls, in that case, these are the fallback options, or these are the next course of action that we have already planned for, right? So risk mitigation as a like pillar is nothing but it can stem from just your risk register, which will account each and every sustainability related risk and climate related risk, which will also account your acute physical, acute acute physical and transitional risks, all the related risks that has to be accounted for. And apart from this, how we have identified this risk, what is the process of prioritization, what are the next steps that you are taking, what kind of mitigation strategies that you have taken. And this is where the linkages comes into picture, that for this particular risk, this is what is the governance, the governance model is going to look after these things. And we are going to percolate this down to the entire organization through our policies. This is going to be the SOP that we are going to follow. These are the key parameters, key KPIs that you are going to track, and these are the people who are going to be responsible to track these, and their performance is going to based on how these indicators are being monitored and being achieved in the organization. So risk management is a centerpiece of this entire reporting, because this is where you will link the earlier two pillars that we talked about, the strategy, the governance structure, and the next step that we are going to talk about, your KPIs and matrices, come together and align, because this is where everything is going to be making sense for any organization to show that, yeah, we have done a materiality assessment, we have identified these are risks, this is going to be impacting my revenue by 10%, 20% in the next 20 years. That's why we have kind of created this mitigation steps and methodologies. For these, the governance structure is this, the KPIs that we are tracking is this, these are the indicators that we track, and this is the next course of action that you're going to do in the next few years if there has been any negative or positive impact out of it. Right. So this is basically the holistic approach around risk management that we need to discuss.
Yep. So another quick example you can see from the Emirates NBD group. So they're talking about their climate risk management, right? Specifically for climate risk, which is your IFRS S2. So they have a climate risk policy that incorporates that risk, and it's already integrated into their overall group's risk management framework as well, right? So it's not just that only the investment company or only certain other companies are looking at it. The entire group, overall group's risk management includes climate risk as well when they're considering, their financial planning, their financial modeling, their strategy, right? So climate risk is something that's the way that they're looking at climate risk. And Abhirup also talked about the connectivity, right? So if you see the second point, it says the governance and process. So it says that the board committee, so which was your governance pillar, the first pillar, and that is now linked to the third pillar as well. So how is the board being, provided updates on their climate risk activities, right? So that's how they're linking both these pillars, right? So that's how they're reporting, how is climate risk, how is the other sustainability risk integrated into the overall risk policy, and how is the board getting involved in that, in those discussions, how is the board getting informed, what is the board's oversight as well. And on the right, if you see, sorry, just one second. On the right, if you see scenario analysis, right? Because they're a financial institution, scenario analysis is something that's very important for them, right? Any financial institution, any bank, any insurance company would definitely use scenario analysis for their future planning as well, right? And even if the IFRS S2, if you remember, there was a point about scenario analysis. So they have looked at the NGFS scenarios, which is the network for greening the financial system, right? So most banks use the NGFS scenarios. There's about 7 scenarios that they published, of which Emirates and BD has taken 3 of those scenarios, and that's how they have gone about defining their entire investment and insurance policies as well. That's how they report all this. Yeah.
Okay. So now moving on to the fourth pillar, which is nothing but matrices and targets. So like I mentioned, this is again going to be interrelated to the risk and opportunities that you have identified. So let's say like if any company identifies that from a climate related risk, my transition risk could impact my company's revenue by 20-30% by 2040, right? So that essentially means that they're anticipating that they're going to be carbon tax either in the region in UAE, or maybe they're going to be there are definitely going to be some kind of climate related risks, or maybe carbon taxation in the geographies where their clients and customers are present, right? So that is where we need to, like, first of all, track what is our carbon emissions, how we are going to be decarbonizing our operations, and are we trying getting the right or desired outcome out of it. Let's say, like, if I'm saying that my revenue is going to hit or impact by 20% by 2040, ideally, I should have my decarbonization plan ready by today so that we can achieve or negate or maybe like minimize the impact from 20% to, let's say, 1 to 2% or in a single digit, right? So that would be the strategy. And that is where these matrices and targets will come into picture, that by 2025, what is the target that we are trying to achieve? By 2027, what is going to be the target? Are we going to focus on, let's say, only a scope 1 reduction or a scope 2 reduction? If, let's say, it is a scope 2 reduction, are we going to adopt to a, let's say, a renewable energy? If it is renewable, it can be, let's say, I'm talking towards group captive, or maybe it can be like internal solar rooftop or any kind of co-generation that we are looking at. So those kind of things will come into picture, and that is going to be reflecting in your matrices and targets. So matrices and targets, again, like I mentioned, on the IFRS and IFRS S1 and S2, this is one of the areas where the reporting requirements would be different for both the things, because like till now, risk management, the governance, and your strategy can have a single narrative or can have a holistic picture for all of the things that we discussed together. But for S1 and S2, in terms of matrices and targets, the requirements will be different, because obviously the KPIs and the goals and targets for each and every topic will be different, right? So that is why we have to be very much mindful about that. What kind of data that we would be needing for this? See, first of all, anyway, financial data is going to be the uttermost priority here, because I mentioned like risk, opportunity, everything has to be quantified as per the financial metrics. Non-financial data, which will be mainly your board oversights, committee structures, management roles that you are going to anyway disclose in your first pillar. Similarly, the strategy, what are the results of climate-related scenario analysis that you have done, that NGFS scenario that Kushagra just mentioned, right? Similarly, on the risk management framework, what is your risk management framework? What is the risk profile that you have, the risk registers, then kind of mitigation steps, investment strategies, and all of these things has to be part of it. And then in matrices and targets, like for your S1, it might be including, let's say, your carbon emission, like your scope 1, scope 2, scope 3 data, which is mandatory anyway for S2. This can also be covering, let's say, if you have water-related risk, water consumption, water recycling rate, or maybe like water withdrawals from, let's say, groundwater sources, any kind of such matrices can be taken. Similarly, energy consumption, what is the percentage of renewable energy that you have in your portfolio today? So again, like there are not hard setting rules or like KPIs that you should be taking, but then definitely there are some general guidelines that you should be following there. And that's where I just wanted to like bring again the same topic, that this is like IFRS S1 S2 gives you the flexibility to the maximum level, that you can pick and choose your metrics and targets. There are very few which are going to be mandated by them, but then you can take that as per my strategy. These are the 10 things that we should be tracking, and these are the metrics and targets that we have taken. That is what we are trying to disclose over here. So this is basically the foundation around that. Over to you, Kushagra.
Yeah, as you can see, it's not just environment, but a lot of social and governance targets as well that they've reported. And targets, so for example, percent of local suppliers, right from the local procurement that they're reporting on, board independence, gender diversity, board level. We already saw that they have a target of 25% board diversity as well, right? So there's a lot of targets that metrics and targets that they're reporting. Right from water, waste, environment, social trainings, employee trainings, a number of training hours. There's a lot of targets that they've actually, sorry, not targets, there are a lot of metrics that they're actually reporting on. The targets is something that we had initially seen that put, their certain net zero targets, their targets around their financing the economy as well, right? So those are their targets. These are the metrics that they are now that they have been reporting their progress on against those targets as well. Again, it's a very small snapshot. They have a lot more metrics that they have reported, but for the purposes of keeping it concise, we just taken certain snapshots. Yeah.
Okay, so I believe we have covered all the four pillars that are there in IFRS S1 and S2, right? Now, an obvious question that comes to anyone's mind, and this is a question that we have been asked multiple times by multiple companies, is that if we want to go and approach our IFRS reporting, right, and or maybe get prepared for IFRS reporting, what are the steps that we should be taking, right? So this is basically a preparation roadmap that we want to share. And again, like there's the industry best practices collected together and collated together for all of our general understanding. So first thing first, as I mentioned, we started with governance itself. Like that's where the first thing that we would need is a governance buy-in, because there has to be someone as an anchor on the board or maybe in the top leadership who should be looking after all of these things, because anything about sustainability and anything that you're reporting in IFRS S1 and S2, like the intention is that if any topic which is financially impacting any company, that should be relevant and that should be important for the organization, and that's where the board or the leadership has to be accountable for it. Because when you are reporting your financial metrics to the investors, they are also looking into your financial performance. Similarly, in an IFRS format, what they are also expecting is that you should be looking into sustainability risks not as a separate topic than your financial risk. It should be a single approach that the company takes. If you are dealing with your financial related risks in your uttermost priority, then these risks are also going to be the same priority for you, right? So the first thing would be a buy-in from the governance and kind of creating a structure around that, which should be a board or like a C-suite level structure, and then percolating down to your employees and employee groups. So after that, where you can find out that what are the gaps that you have in your organization, right? So this is basically a gap analysis that you can do internally. If you have a sustainability team, or you are like already aware of the IFRS requirements, or maybe you are also working with any consultant, you can definitely ask them to kind of help you with a gap assessment, so that you know, understand what kind of policies that you need, what kind of company or committee structure that needs to be followed, what kind of strategies that can be made out, the climate risk scenarios can be populated, what kind of scenarios will be replicable, relevant for you, what will be the financial impact in the next 5 years, 10 years, 20 years in as per the models and all. So this is where you can do a gap analysis. You can also find out a checklist which is already there by sustainable SSE checklist that we have already linked over here, and you can definitely find it out. We'll share this PPT with you after the webinar. You can definitely use this checklist for your internal identification as well. Right now, moving to the third step, as I mentioned, everything revolves around data here, right? In sustainability, as all of you would be aware, that everything revolves around data. The answers that you are trying to communicate in terms of your stories and narrative has to be reflecting through the data that you are projecting or showing to the larger stakeholders. And that's where you have to, first of all, identify the data owners. Because before even going towards the data, you should know exactly who are the data owners, which functions own this, which companies owns this, where should we collect this data? Is it going to be only internal data? Do we need to also engage our suppliers, vendors to get this data? Are we going to follow a certain standard? Are we going to follow a certain methodology, like your for your carbon accounting? Is it going to be operational control, financial control method? Are we going to use IPCC as a emission factor database, or DEFRA, or a combination of that? For scope 3, are we going to go for, let's say, spend-based approach, or a supply-specific approach, or a hybrid approach? So all of these things are going to be the part of the entire data collection system. Now, the next part is going to be the strategy around disclosure, right? So as you already have by now understood that, like the initial governance and the data collection in terms of the problems and challenges are being identified. Now the strategy has to be more around, if let's say we want to go for our IFRS reporting for this financial year, right? Like which is going to be in January for you. So in that case, we have, let's say, a couple of months in hand. So are we in a position to kind of do everything, collect this data, have everything in time to be reported, or shall we, let's say, do it for next year, right? So that can be an obvious question. If you are going for, let's say, next year, what are the timelines that you're looking at? How we are going to come up with a structure? How it's going to be board accountable for it? What kind of KPIs that we should be percolating down? How we are going to communicate it internally? How we are going to communicate with our external vendors? And all of these things has to be taken into account, so that you can create the strategy of rolling out this process or a disclosure process, which is going to be a requirement for you. If it is a mandatory requirement for you in your certain geography, in that case, definitely you don't have this choice of moving your timelines. In that case, you have to definitely have a backtrack approach that by this date, we have to anyway disclose our report. So with the available timeline, that is where this winning strategy comes into the picture. By next couple of months, what are the things that we can do? What are the steps that we should take, and is it going to be done internally, is it going to be externally, and all. And finally, disclose that in the format of the report that you want. If it is also a requirement for you to have an assurance around that, you can definitely engage any kind of external consultant who can help you with that, what subject matter experts there. So this is going to be mainly the preparation roadmap for any company who wants to get started with this. I would now invite Arushi to just speak about it.
Perfect. Thank you so much, Abhirup. Thank you so much, Kushagra. That was amazing. I also have a couple questions parked for you guys, which I've received a couple on my private chat as well. I'll pick them up in a minute. So, folks, I think you're just closing all of this in, and what is the significance of the standard in the MENA region, right? I think number one is something that I said initially, and something also that Abhirup started with, right? Uh, the big focus, I mean, while the MENA region might have been a late starter when it comes to the sustainability adoption journey, but nevertheless, they're moving really, really, really fast, right? We're talking about IFRS, right? The MENA region did have its first company, and there are lots of other regions which have been doing sustainability reporting for a long time, and then they don't have a company reporting on the standard as of yet, right? I think I was kind of having some back and forth with Madhvi as well. I think something very important that she mentioned is that, yeah, while Emirates NBD did put out this report, there's still a lot of work to be done, right? I mean, yes, while they're a first mover, it's still not like world class, right? There are a lot of key metrics. There's a lot more that can happen as well. Like nevertheless, it's still a start, right? The big reason is that just to have like a universal language across multiple countries, multiple geographies, and multiple industries also for that matter, right? MENA wants to kind of be one of a player on that global stage. Right. In addition to that, there are a lot of investors, a lot of global investors that are looking at MENA for investment opportunities across sectors, right? And having a sustainability standard that's maybe not developed internally by themselves, but something that kind of is the cutting edge on the global platform is something what the region is aiming at being, to be able to attract those investors as well. And of course, COP28 legacy, right? The region does want to continue and does want to keep on building on the momentum that was started because of the COP, right? There was, I mean, ever since different countries in the region have come up with their own commitments when it comes to the sustainability reporting standards, when it comes to even implementation, right? There are renewable energy goals, right? There are that I think I was reading somewhere that Dubai also has goals around greening the city, right? And I think just beyond that, multiple other goals as well, right? So yeah, I do think there is a lot more that's coming our way. One in particular that we'd like to talk about is also is by Abu Dhabi Securities Exchange. They have been a front runner when it comes to mandating ESG, right? Today, while they do not prescribe the IFRS as a reporting standard, they however have mentioned that companies can feel free to either pick GRI as a standard or IFRS standard as well, right? I think with that, I'll just quickly want to also spend 1 minute telling you a little bit about who we are, what we do. So we are Oren. There are two key pillars to our business. The first one being a technology platform, which we call the Oren Sustainability Hub. And the companies use it to do GHG, emissions accounting, sustainability reporting. We, of course, have the IFRS standard built in, right? We have GRI, we have all global frameworks, right? In addition to that, in case companies want to do certain custom reports as well, we develop those for them. We do a ton of work in supply chain sustainability. We do ESG peer benchmarking through the platform as well. In addition to that, Abhirup Kushagra, they have a large team of consultants, project managers, analysts who help us deliver certain services and solutions as well. Some of those have been listed, right? SBTI, decarbonization strategy, risk advisory, ESG trainings, ESG ratings, policy advisory, to name a few. Right, we have 3 minutes, so I just have a couple questions that I've got on private chat, which I want to ask you guys. So someone asked that, okay, this particular company, they did they created a GRI report in the previous financial year. That was their first sustainability report, so they already did a materiality assessment, right? Now they are exploring the possibility of doing an IFRS in the next either the next financial year or the next to next financial year, right? Will they have to do a double materiality? Will the materiality assessment exercise done continue? Right? What advice would you give them on this piece?
Okay. So if you have already concluded or did your materiality assessment, then in that case, that makes your job easy for your IFRS, because as I mentioned, for IFRS, there is no obligation for you to do a double materiality. It can be an impact materiality, but then one thing that you have to do additional to that is actually quantify the financial impact, right? So like I mentioned, it can be a quantitative approach or a qualitative approach. You have to find out that what exactly do we mean around that. If it is going to be higher in terms of the impact, it can be high, low, medium that you do, or maybe like exact quantity that you measure. Based on that, you can take that approach. Already, because you are doing GRI, I'm sure like on the governance piece, you would be anyway sorted, because in GRI also you have to disclose your governance models, what are the competencies of your governance teams and all. So in that case, at least a couple of pillars would be there. It will be just an extension to the existing materiality that you have done there. You don't need to do it again.
Thank you. Thank you so much, Abhirup. There's actually another, while we're on the topic of materiality, there's another question on materiality. And this gentleman asks that and again, please feel free to unmute yourself and clarify in case I'm messing something up. But what this gentleman asks is that which stakeholders should they include in their materiality assessment, right? The reason they ask is that they're a B2B company, manufacturing, and most of their customers are outside the MENA region, right? They're headquartered in Dubai, right? Their customers are in Europe. So do they also have to include their customers in their materiality assessment?
See, when we talk about materiality assessment, the more is the better. That is the approach that you should be taking. Like ideally, there should be at least some representation from each of the stakeholder groups, like your investors, your, let's say, employees, your leadership team, your customers, your vendors and suppliers. If you can plug in some regulators also, that would be really great. Your community representative, if you are working with through an NGOs or maybe directly with the communities, their voices also matters. And at the same time, you can also plug in your like banks and financial institutes if you work with them. So if you have a healthy mix of representation from each and every stakeholder, that necessarily shows that you are like whatever objective that you are trying to achieve out of your materiality assessment is actually being achieved, because you will have a holistic view from different angles, right? If you just focus on, let's say, taking in like views of leadership and employees, it will be just a one-way approach. You don't know exactly what are your suppliers asking, or what are their risks and challenges, what they expect from you. Similarly, a customer would say that, like, because as we are discussing that if your customers are based out of Europe, right, and you are based out of a MENA region, they might have certain concerns, certain things about you and certain perception about your company, right? So they would be able to highlight that those risks and opportunities for you from their lens. So the more stakeholders that you involve, and customers definitely, that will help you get a better, broader perspective from a materiality assessment viewpoint.
Got it. Thank you. Thanks a ton. So, folks, we have exceeded the time limit, but I just have one last question, right? And again, open to both of you. So, now this in terms of this question, so this company, they've done like a very brief peer benchmarking. They don't have a sustainability report yet, right? And I believe from what I understand from the question is that two of their competitors have already done a GRI report, right? So which reporting standard should they pursue? Should they look at an IFRS? Should they look at a GRI? Right? What reporting standard would you recommend this manufacturing again organization?
Well, this is a very tricky and subjective question, right? Like, if your peers are doing this, that is not the right way to look after it, because like peers might be doing something and the other, and like if they would have been doing everything right, then you will be also following the same thing that you are doing, right? So ideally, what I would recommend is that look at what are your stakeholders' requirement. If you don't have any compliance requirement, then definitely like push it out of the window right now. But then if you have investors, if you have customers who are from certain geography, like let's say if it is in Europe, right? Europe would be definitely looking at GRI, and they're also open to IFRS. Look at if you're like major 5 or major 20% of your customers who are coming from certain geographies. In those geographies, if IFRS is a mandate or not, right? That will give you an answer that if you align your reporting requirements as per IFRS, that will help you to be in a win-win situation for both your customers as well as your company, because you are aligning with your like major customers or the high revenue earning customers there. If you, let's say, have certain investors who are from, let's say, certain geography where the IFRS is a requirement, or maybe if they are reporting in a GRI format, or they are like using GRI as a primary way of communication, in that case, GRI can be a certain way of communication, or that might be the most relevant way of going around that. Because see, like everything from 0 to 1 is going to be a heavy lifting for you. Either it is GRI or an IFRS. Only thing in IFRS is that there is a climate related risk which is being added. Now with the latest standard of GRI, anyway, the climate related risk are anyway has to be added, right? So it is going to be anyway similar approach, similar kind of heavy lifting, either framework that you choose there.
Perfect. Thank you so much, Abhirup. I really don't know how you remember all of these things, right? But nevertheless, we're so glad that you and Kushagra can share this information with us. But again, thank you so much, both of you. This was a lovely, lovely, lovely session.